In this section, you need to define key working capital assumptions based on your business cycle. Working capital is like your business's everyday spending money. It's what you need to run your business while waiting to get paid by customers. Let's take ABC Furniture as an example. They buy wood, which means that they procure inventory. Keep it in the warehouse for 20 days, which is inventory holding. Take 15 days to make furniture, which is the production phase. Sell to customers on credit. Follow up on payments, which means reminding customers and managing receivables. Receive payment after 30 days. And the cycle repeats. So, how much would be their inventory days? Their inventory days is 15 days making plus 20 days storing. This means they need enough money to cover 35 days of inventory costs. But if you're XYZ Consulting, a services company, you don't store any products. Your inventory days would be 0. You only need to worry about how long clients take to pay you, like 30 days after you deliver your service. Inventory days, how long on average inventory stays before being sold. Accounts receivable days, the average time it takes for customers to pay after a sale. Other current assets days, the time required to convert other current assets into cash. Accounts payable days, the average time taken to pay suppliers. Other current liabilities days, the period within which other liabilities are settled. Ensure these values align with your actual business cycle to get an accurate projection of your working capital needs. That's it.